Welcome to Idea to IPO. Hello, I'm Jennifer Stowell. Idea to IPO has been holding tech startup events in Silicon Valley for many, many years. We launched officially on February 1st, 2010. At that time, we had no members and no events on our calendar. At this stage, we have over 150,000 members among all of our meetup groups all across the world. We have organized, promoted, and produced over 2,610 events. By any standard, by any measure, we are the most active, most prolific startup event organization in Silicon Valley, bar none. We organize venture capital panels, legal workshops, networking events, and more. These days, we are 100% online. We hold an event nearly every day of the week. Check out our schedule at idea2ipo.com. At this point, I'm going to hand it off to our distinguished moderator, Jason Putnam Gordon. Jason, take it away.
Wonderful. Thank you very much, Jennifer. It's a pleasure to be here today. We've got a fantastic panel for the audience. We're going to be focused on discussing investment in energy and climate tech companies. Before we do that, what I'd like to do is sort of start off with letting everyone know what the format is for today. So as we let the attendees populate today's virtual webinar room, please fill out the audience survey poll. I'll let you know who's in the room shortly in terms of location, where they are in terms of company life cycle. Additionally, what we're going to do is we're going to have the panel speak for about an hour today. We'll take Q&A on the back end for about 30 minutes or so. Please use the Q&A function rather than the chat function if you want to pose a question to the panelists. That's easier to track. Sort of in addition to moderating, I'm also running the tech in the background. So it's the fewer things I have to try and focus on, the better job I'll be able to do. So help me help you. Today's panel is recorded. So the great thing is if you've missed some or all of it, you'll get the opportunity to view it later. Downside is please don't share any confidential information or say anything that you don't want to be recorded or memorialized for posterity, because it's going to be put in the web and kept there for indefinitely. With that in mind, let me tell you who's going to be on our panel, and then we'll start by having the panelists each introduce themselves. So we've got Carolyn Funk from Blue Bear Capital, Katie McDonald from the New York State Energy Research and Development Authority, and Emily Fritz from the Wesley Group. With that in mind, maybe we'll have sort of the returning champion, Carolyn, tell us a little bit about herself, where she's at, and what sorts of companies she works with and invests in. And then we'll go around the circle. Thanks.
Sounds great. Thank you, Jason, for the introduction, Rob, for organizing, and everyone else here for making their, if you're on the West Coast, lunch hour available to us. If you're somewhere else in the world, likely late evening. So great to be with you here again. Yeah, I'm Carolyn Funk. I'm with Blue Bear Capital, as you see here in my background. I bring a mix of operations from startups, large corporate experience and policy together here, all focused on the energy and climate industries. I started working in this space about 15 years ago, very much during the climate tech 1.0, or when we called it clean tech 1.0 era, in Berlin, researching advanced biofuels and the effect on internal combustion engines. And moved over to the policy side, worked in a public-private partnership group called German Energy Agency to work on the policy of the energy transition that's now unfolding over there in Germany. I felt that was moving slowly, and so moved to the Bay Area to be more entrepreneurial. I'm talking to you from Berkeley, California today, and actually worked at Siemens for a number of years, a group that's now part of Next 47. That's Siemens' $1 billion startup partnership and investment arm, really focusing the smart grid and digitalization topics over there. I was a COO of 2 different energy storage businesses, taking them through seed, Series A, and beyond, raising institutional capital, but also government grant funding, one being FreeWire Technologies and the other is called Kaban Systems, at the intersection of energy storage and EV charging, and the other one at the intersection of energy storage and the telecom industry. I'm an investor at Blue Bear Capital now. I never set out to be an investor, but I really think it's a terrific opportunity, and we're going to talk more about why the timing is right for investing in this space now. Our focus is on investing in companies at the digital side of energy infrastructure and climate industries. We look for companies that tackle the operational challenges of the energy transition, the industrialization of renewables, basically taking everything up to larger scale or getting projects rolled out faster. The right company for us to invest has already the first handful of customers, products ready to sell, because then we can come in and help with growth largely through our network that's from the energy private equity industry and also much of our LP base. We invest, our typical check size is between 1 to 5 million, and we invest from seed to Series B, but we can get into more details later.
Thank you. It's wonderful to have you here today. And Katie, would you tell us a little bit about yourself?
Sure. Thanks, Jason. Yeah, excited to be here today. Hi, everybody. Katie McDonald. I'm calling in from the East Coast. I work for, as Jason said, NYSERDA. We are an authority founded in New York in 1975 with the mission of advancing clean energy solutions and innovations that can help the state improve its environment and its energy infrastructure. And my job is I run our tech to market team. And so there's a scrappy group of us that are focused at the authority, not on the commercially ready products that much of the authority gets out into the market, whether that be new HVAC solutions for homeowners or solar finance plans. But my team really focuses on the new climate tech stuff. So products that really have yet to, have first major milestones with customers that are really mitigating the final elements of their technology risk before scaling. So before NYSERDA, I was executive director of Clean Tech Open Northeast, which is a region of Clean Tech Open, the world's largest clean tech accelerator. And that's where I met Carolyn. And then I moved over to Greentown Labs, where I designed and built Greentown Launch, which is a corporate accelerator model that Greentown Labs pioneers. They're the largest climate tech incubator in the country, actually, I think North America, over 300 companies. And that program is really focused on thinking about how can you get large corporate strategics that are essential to bringing products to market in this sector to partner and to put resources and money down into high quality climate tech companies as quickly as possible to facilitate speed of commercialization. So ran over 8 of those programs, deployed tens of millions of dollars through that model, and then decided I wanted to go work for the government. So that's what brought me to NYSERDA, and excited to speak more about what we're doing over here.
Terrific. And we're definitely going to have you do that shortly. Thank you for being here. Emily.
Hi, everyone. Great to have you on today. I'm excited for this conversation. A little bit on me. I am currently an investor at the Wesley Group. Before joining this firm, I actually started my career working in Washington, D.C. I started working for a congresswoman named Gabby Giffords, which is where I started to learn about energy and climate, given her passion. I then worked in the Obama administration for the Secretary of Energy. At the time, I worked as the chief of staff at the Advanced Research Projects Agency for Energy, which is an agency that funds early stage, high risk technology in energy and climate. And then I worked in the Obama White House, focused on energy and climate. I then moved out to San Francisco when the Obama administration ended and joined up at Powerhouse, which is a clean energy innovation firm and seed fund in Oakland that invest in early stage clean energy and mobility startups. And so I helped run Powerhouse's innovation firm, including partnerships with large corporates focused on energy innovation, and also helped raise their seed fund and invested in early stage companies. And now I'm at the Wesley Group. The Wesley Group's a venture fund in Menlo Park, just right in Silicon Valley, where all the many venture funds are. We've been investing for 14 years in clean energy, transportation, Industry 4.0 in buildings and prop tech. We are typically investing in Series A and B companies, although there's some flexibility, but our usual check size is 2 to 8 million. And when you look at our portfolio, you might see that about half is makes up kind of traditional tech, enterprise SaaS, including cybersecurity, autonomous vehicles, and then the other half ends up being more of sort of classic clean tech, mostly digital and business model innovation. Some of our notable investments, we were Series A investors in Tesla. We're invested in Luminar, a company that just went public. That's a LiDAR company. We're in Planet, a satellite company, and Sentinel One, a sort of notable cybersecurity company. So happy to share more on our firm, but looking forward to the conversation around climate tech and all of the latest trends and observations that all of us are seeing.
Terrific. Well, we are very excited to have you here today, each of the panelists. Sort of last and least, I'm Jason Putnam Gordon. I'm a venture capital and emerging growth company attorney based in San Francisco, California. I work with energy and climate tech companies. And let me share with you a little bit about who's in the room today. So we got the composition is 25% roughly from the Bay Area. We've got another 25% from elsewhere in the US. And then the rest of the folks are basically out of the US, which is fantastic. And we also anticipate that because this is recorded and because we'll share it with the registrants who are not here, usually we see several hundred folks will watch the video afterwards. So this is going to be very helpful for them. We've got about a third of the room are first-time entrepreneurs, followed by a quarter of the room as serial entrepreneurs. We got a few angel investors, a few corporate VCs, a few financial VCs, some folks who are in early stage companies and some folks who are in growth stage companies. So, and then we've got a hodgepodge of miscellaneous kind of on the tail end of that. Now, what we want to do, because we've got Katie and Emily here and Carolyn, is we want to have a conversation today that sort of matches up with the intersection of policy and investment. And kind of before we kind of dig into the meat of what we're currently seeing in the market and what we see moving forward, I think it'd be great if we had just sort of a little bit context, a little bit of background, maybe about, as Carolyn mentioned, Clean Tech 1.0, what were some of the things we saw there? What were some of the challenges? And we can use that then as sort of a launching point to discuss why things are maybe the same, why they're different, and what we see come down the pike. Carolyn, would you mind sharing a little bit with us about Clean Tech 1.0?
Yeah, I think it's totally. I think like the definition of Clean Tech 1.0 is broadly kind of the investment, the first hype, if you will, on investing in clean tech companies, much around the kind of 2007, 8, 9, 10 timeline, where the industry was just starting to grow. We were just kind of getting more installed solar base. We were just kind of figuring out that electric cars could be a thing, and how to use batteries in a broader sense. But a lot of the investment that was made back then was in very asset heavy material, kind of new material development, very capital intensive timeline of the business, and applauding to Wesley investing in Tesla early and taking on that risk. A lot of the companies that did those investments back then are not around anymore or got burned in some of their funds there. And the main difference to where we are today is that a lot of the material and kind of hardware risk has been taken out through research, a lot of funding that's coming from different organizations like the ones that Emily and Katie have or are working in. And I can say also from the European perspective, a lot of European, like a lot of government funding. And now we can see that costs has come down. Solar and wind are the cheapest source of electricity in most of the world, and that is now generating new business opportunities and investment opportunities that are more capital light. That's where I think Emily and I are most focused on. So not hardware centric, new kind of new hardware developments, and the market is there, and also I think what, in my perspective, would love to hear what the others are saying. In my perspective, the last 2 years have made the topic of climate change much more visible to more of the country and the world, and so it's top of mind, top of the news. So also the acceptance is much bigger now.
Oh, thank you very much, Carolyn. That was a great summary. You know, and you mentioned that a number of the investors back then got burned. I mean, I read that I think 50% of the dollars that got invested in Clean Tech 1.0 were lost. So it's pretty significant. But that's then, and this is now. So Emily, maybe that's a great segue for you to chat about what you see coming down the pike and where we're at.
Yeah, so also just to kind of address that statistic that you mentioned. So in some of the meta-analysis that's been done since, you know, the investments that happened in 2007 through 2011 or so, you know, what's interesting is that a lot of money was lost. But if you look a little bit closer at where that money was lost, you know, it was mostly lost in particular areas, including solar, when it was, you know, solar modules when they were commoditized, and China in sort of imports took over, and China won the race. Materials, biofuels, and so those, you know, it was very specific, capital intensive, hard tech, long time frames, you know, areas, frankly, that, you know, most investors probably shouldn't have been investing in if they thought logically about the model for venture. Interestingly, there were some successes, and there's much stronger returns in that period from, you know, Series A investments in software and digital solutions. You know, and so and of course we know of a few prominent examples that kind of have outsized returns there, like Nest and Opower. But you know, I think that's an interesting point to note, which is that one of the biggest lessons from Clean Tech 1.0 is that, you know, certainly hard tech and big swings can work. Obviously, Tesla is a great example of that, and that was one of our sort of bigger swings from an investment standpoint. But, you know, on the whole, you know, a lot of those models, especially in energy, where these companies are selling to large incumbents who are very slow to change, slow to procure, they just don't fit quite well with the venture model, which is that you're looking for returns basically within a 5 to 10, you know, year span, and you're looking for also rapid growth. And so I think that lesson has been learned mostly as we look towards clean tech or climate tech, this second wave of hype and excitement. But there's also a couple other things that are different. You know, one is that we've seen we're not relying upon just regulation like a lot of folks anticipated in the past that did not occur. We are seeing significant amounts of commitments from private companies to basically have net zero emissions. And so it is creating market opportunities oriented around sustainability, you know, carbon removal, and you know, effectively a market where there really wasn't one before. And so, you know, we're really excited about that. We think as a result, there's, you know, with some careful, thoughtful investing, there's some really, really good opportunities in the climate tech space. I'd say one point in which we might differ is that because of our lessons learned from the past, our fund would still be reluctant to invest in some of the deep decarbonization technologies that you might see some new funds focused on climate invest in. Some of them are investing in those spaces because they believe that that they've set up a fund with a more patient capital structure that allows for those timeframes and those expectations, like Breakthrough Energy. But some are really making a big bet that things are a little bit different and that they can still make those big swings work in a venture model. We would be less likely to do that given some of the lessons learned in Clean Tech 1.0. But we think there are really exciting opportunities around the electrification of basically everything, around climate tech, carbon tech, especially around sort of markets, digital solutions, big data, the digitization of energy, the greening of supply chains, just to name a few. And so, I think, only time will tell, but we're really excited about the sort of step change in not just the economics of clean energy, but also the sort of market pull coming from private companies that just didn't exist 10 years ago.
No, that's terrific. I couldn't have asked for sort of a better unpacking of that general statistic and all the lessons learned, and also how there might be some trepidation in certain areas kind of moving forward. Katie, do you have any thoughts or anything to add?
Yeah, thanks, Jason. I mean, I think Emily and Carolyn gave a really great overview of like the state of the industry and how it's like really notably changed. I mean, I'll just sort of table set and say, as some of you may know, the state of New York took a nation-leading policy position on climate in 2019 with the passage of what we call our Climate Act, or the Clean Energy Community Protection Act. Climate Leadership and Community Protection Act. That put the entire state on a path wherein, we're looking at economy-wide carbon neutrality by 2050. And we're looking at 70% renewables by 2030. So some really ambitious interim goals and some very kind of ambitious, decarbonization goals broadly. And, what that means for innovation in the state is, as Emily alluded to, we can't afford to just be thinking about bits and watts in the electric grid. That is critical. We know we need to be bringing massive renewable energy projects online. We actually just in the governor's state of the state this year in New York, he announced 4,700 megawatts of large-scale renewables, which once deployed in the next few years will mean that 50% of New York's electricity supply is coming from renewables. So these are really massive projects. We know we need to do the work on the electrification side. But once again, back to Emily's point, some of you may have read the Bill Gates article. I think it was in 2018. I'm pasting it in the chat. We've got 75% in most places of emissions not coming from electricity. And that means that if you're the government and you're thinking about hedging and ensuring that we can meet critical policy targets on behalf of the public, you have to start thinking about innovation in those areas, which includes transportation. What are we going to do about long haul trucking and transportation emissions that you can't decarbonize through electrification? What are you going to do about buildings? New York has 40% of our emissions coming from buildings. We have some of the oldest building stock in the country. That's going to take a tremendous amount of retrofitting, a tremendous amount of data accountability. That's a huge market opportunity. Manufacturing. We have one site, I think I mentioned this to Carolyn today. Today I was on the phone with Lafarge Holcim. This is a cement company that has a carbon footprint larger than China's. They have a facility in New York. It is the highest emitting building in the entire state. And quite a bit of the emissions on site are almost impossible to decarbonize with technologies we have today. So these are some of the challenges we're thinking about. And there's a really beautiful, I think, complement to be had between government and public funding and some of the dollars that Carolyn and Emily offer, in that, it is the government's role, as far as we're concerned, to make critical investments to then catalyze private sector dollars. So to take risks where others will not, so that as we look at some of these emerging sectors, we can get critical innovation going that might take, 15 to 20 years to reach the markets that we need it to.
No, that's terrific. Well, I would welcome and love sort of a free form discussion of the panel, kind of talking about those intermeshing of those two roles and what you see kind of shaking out now and kind of in the near future, and as it relates to venture in particular, which is a soft spot in my heart.
Yeah, I mean, I think one thing to say on that is that, that Katie alluded to is that there's sort of different roles for different types of capital in climate tech, in clean energy, in decarbonization. And I think one of the biggest evolutions that's happened in the last 10 years is that there's much more creative private capital out there for clean energy and climate tech startups that is perhaps a better fit for the types of companies they are. There's some pretty prominent firms now that are focused on project finance and debt facilities that are, in a lot of cases, just a better fit for sort of heavy infrastructure project oriented startups. And then there's the government, which, between ARPA-E, the Department of Energy's ERE program, and then the numerous, outstanding programs like in California, the CEC program, EPIC program, and the NYSERDA are, pumping in billions of dollars into climate tech, and doing so at a stage where, startups and technologies are not really a fit for venture capital necessarily, given the risk and given that they're maybe more at our, research and development phase. But then de-risking those technologies to the point where private capital, whether it's venture capital or other types of capital, could get on board with the technology risk. And really, at that point, it's more of a commercial risk consideration. And so I think it's once again a story of the power of public-private partnerships, the power of government. There's a lot of sort of government bashing, but there's no doubt, especially in this space in climate tech and clean energy, that government plays just a crucial role on the funding side, but of course also on the regulatory side. And I think what will be super interesting over the next year or so is now with the Biden administration, considering what types of policy and regulation will come down the pike that might have an impact on climate tech and even venture capital. I think a couple of things we might expect are, to start some sort of climate disclosures requirement from the SEC that, requires that companies disclose their climate change risk, whether it's their assets or the financial risk to their assets, and might include, them reporting on their GHG emissions, including carbon. So you could imagine that having all sorts of impacts on startups who are working in this space, as you start to see not like a full-fledged carbon market, but sort of requirements that at least put a lever on companies reporting out on these items. I think we've already seen Biden introduce an infrastructure bill on the Hill in Congress that is proposing to fund clean energy as sort of the major stimulus, once again, similar to the Recovery Act in 2009, but with a focus on electrification, carbon capture and sequestration, green hydrogen, electric vehicle charging, to name a few sort of priority areas. And that certainly has the potential to really make a difference, especially in deploying some of these technologies that are already proven but need capital to just get out there in abundance. And then, finally, I think there is a possibility we see some sort of action on carbon. I think it might be hard politically to see a full-fledged carbon market, but it's possible we see a carbon tax in some form. This week, Gina McCarthy, the domestic policy lead for climate in the Biden administration and the former EPA administrator, had a meeting with a number of oil and gas majors. And what was reported coming out of that was a much more of a sort of cooperative stance from U.S. oil and gas companies, even including Conoco and ExxonMobil and some others who haven't historically really been all that supportive around some sort of carbon tax. And so certainly that's no indication of what's to come, but it's promising that those types of things are coming together, and they certainly have the potential to move markets and to really create opportunities for startups in the sector. I don't know, Katie, if you have any comments on that too, given your role in NYSERDA and sort of how you guys are observing things from the state.
Yeah, no, I mean, I think all those points you brought up, Emily, are really important. I mean, I think like, once again, New York is really focused on decarbonizing areas that are choke points for New York. So like when we look to the federal government, we're obviously interested in, are they going to appropriate and authorize funding for areas we care about in the state, like buildings and grid resiliency. But, I think with the passage of the Energy Act in 2020 and that 32.5 billion, appropriation of funds towards R&D and innovation, I mean, that's the kind of thing that, to your point, there's a really exciting signal there, I think, for all entrepreneurs that there could be really a handshake for them between receiving support at the state level and receiving support at the federal level. And yeah, I mean, just echoing, I think some of kind of what's been said, like it's, when we talk about state level budgets for this kind of thing, if you look at New York, we have the Clean Energy Fund, which is a $5 billion fund that we're halfway through spending. When you look at the dollar values at the federal level, it's just unequivocally true that they have the power to invest at a scale that the states don't. And so that's where, when we look at, financing for pre-commercial deployments and projects that, will not receive highly risk averse private capital in order to ramp towards proof of concept. And you look at, as Emily said, hydrogen, synthetic aviation fuels, negative emissions, once again, long duration storage. These are projects that cost tens of millions of dollars to fund, 5 or 10 times before they're commercially viable. We need the federal government to step in with the $40 billion at the loan program office and through other vehicles in order to de-risk those technologies. And there are some really amazing opportunities for the federal government and state governments to work together to say, hey, here's this cement plant. We need to introduce a solution that we can't fully afford alone. Let's team up to de-risk it and give American entrepreneurs, a shot at that, give them an opportunity to prove this out so we can replicate success elsewhere.
And maybe just taking that keyword, American entrepreneurs, giving them a chance and stretching that a little further also for our audience. We have some folks that are not from the United States, or at least not calling in from here. And me also still wearing a little bit of the European hat, also amongst our team here at Blue Bear. It's we see a lot of exciting deal flow coming from Europe, and part of it is also driven by the projects and regulation that are kind of spearheaded over there. And for example, even a discussion about a carbon border tax, which is in discussion amongst the European Parliament, is kind of alerting large industrials to really understand their emission footprints. So we've been looking at multiple companies from Europe that do carbon tracking on all the different levels, tier 1, tier 2, tier 3, different types of emissions. And so just wanted to say, wherever you are in the world, if you're in an economy that is thinking about like cleaner, more distributed ways of kind of doing business in electricity, mobility, or industrial, I think you can have an edge even coming here and looking for funding in the US. And maybe that's also one benefit. The silver lining with COVID is that we've spent more time looking at companies that are not just based in California, not just based in North America, but really also in Europe. Disclaimer, our focus is North America and Europe, because that's where we have market knowledge. But I know that there are lots of other investors also looking into Asia and Africa, and of course Australia. So I think there's a global opportunity here.
Yeah, just to reiterate that, I think we as a firm have started to look more closely, especially at Europe. Europe this past year overtook China as the top EV market in the world. The pace of renewable energy adoption, the pace of electrification and EV adoption is happening arguably more quickly than the US even, and certainly on par with parts of Asia. And so we believe there's really exciting opportunities in other markets outside of North America.
I just wanted to say, like, echoing those points, while we know federal money only goes to American entrepreneurs typically, it is still a great time to move your business to New York, shameless plug. And yeah, I just wanted to say we do a bunch of different programs at the state level that are really about capturing talent wherever it comes from around the world. And I just want to say a few things about that. We have a global challenge that we just launched this year. I just put it in the chat, with a grand prize of $10,000 for those that want to partake. We have a new $10 million venture studio called Venture for Climate that just received over 600 international applications. That's receiving companies that need to do some of their early customer discovery and other work in the state. And we also just launched a $6 million, advanced carbon reduction retrofit for buildings program called the Clean Fight last year as well, alongside also a negative and neutral carbon emissions and carbon tech program called, the carbon, the C2V initiative, which is really a first of a kind accelerator for carbon tech and negative emissions in partnership with the government of Canada. So I'm sure Jason will help people figure out a way to get in touch with us. But if you are an international entrepreneur and need resources to set yourselves up in the United States, this is a place where government funds a lot, and New York has a ton of programs for that.
Thanks, Katie. Well, actually, maybe that's a great opportunity to have each of the panelists, if you want to be contacted, you want to be able to be contacted by any of the audience members, if you'd let them know what's the best way to reach out to them or reach out to you, feel free to do that.
Yeah, I think for me, the easiest is if you just reach me on LinkedIn, Carolyn Funk. Pretty easy to find there, but I can also post that into the chat. Maybe that's makes it even easier.
Yeah, same for me. LinkedIn is great. Feel free to shoot over a message or add me on LinkedIn.
Yeah, me too.
For me, I got my LinkedIn up there, and then also I do take office hours because I have gotten a couple of chats about folks who want to talk. So feel free to reach out either on LinkedIn or an email, and we can have a short conversation. So one of the things I'm always mindful of during these discussions is that, roughly, I think a third of the room are first-time entrepreneurs. We talked a bit, I think, Katie, I think you mentioned a handshake, between the government and private investors, and that kind of echoed something that Emily mentioned, which is, there's now kind of a different sense for what is a VC eligible company, and what that kind of looks like. I wonder if we could kind of unpack some of that so that entrepreneurs can kind of get a concrete idea as to, what types of companies you're seeing getting sort of funding, sort of pure VC, what types are capital intensive that it's really not right for VC, and kind of what's in between.
I can, Emily, go ahead, please.
Yeah, well, I guess I'll share, and then Katie, if you want to share sort of what you think where the areas in R&D and in the sort of government programs are most interested. On the venture side, I would say the pure venture firms that are, financially motivated, the generalist funds, they are actually starting to take a look more closely at climate tech, but I'd say their interest is pretty isolated. They're interested in carbon accounting, and whether it's for corporates who are trying to do an accounting of their total GHG emission output and then do offsets. They're interested in companies where individuals have apps where they can track their carbon and offset it via their personal spending. They're interested in electrification, EV charging, software plays. They're interested in electrification of boats and of aviation, including short haul hops of aviation, and to be honest, that's probably the extent to which I've seen generalist firms invest in climate tech. Then there's sort of a suite of firms like Carolyn's and myself that will do broader investments, but we also look at climate tech. We would look at similar areas to the generalist firms, but we have, slightly more expansive view where we're looking sort of across sustainability of all these industries we invest in broadly. So a bit more of a prioritization of climate tech and sustainability. And then there's funds that have popped up that are, decarbonization specific funds, climate tech specific funds, or, breakthrough energy Bill Gates funds, which is will invest under patient timeframes in, very risky hard tech decarbonization companies. And so those are, those firms are ones that there may be some overlap with what Katie might be looking at, but they're investing in anything from like hydrogen aviation, which is pretty out there, to really novel storage technologies, long duration storage for powering anything from 24 to 48 hours of electricity, and clean cement, green steel. So those are a lot of the areas of interest. The last thing I'd say though is that typically those funds are looking for, they're very entrepreneur centric, which in my experience, the government, the government side is less entrepreneur or founder centric. Those decarbonization venture firms, are really looking for certain types of founders with commercial experience who they think can build, quite an ambitious company in the climate tech decarbonization space. But Katie, do you want to mention some of the areas that are of interest on the government side?
Yeah, sure. No, I think Emily covered a great array of areas, and I think it's one important distinction, Jason, that I would share is just that, it's not, it would be excellent if it was as simple as a handoff, but it usually isn't. It's usually sort of more of a dance between government and the private sector, where government will throw in, private sector comes in, and so on and so forth. So there's quite a bit of overlap necessarily, because once again, the commercialization timelines we're talking about are typically 10 to 20 years. So there's a lot that goes on in that period of time. I will say that, we are really interested in funding, once again, where private sector will not. So, over the last 5 to 10 years, as I mentioned in my introduction, corporations have really stepped in. They've set up strategic funds like Next 47, where Carolyn used to lead investment efforts, and they've started doubling down to, become more vertically integrated, tack on new product lines to their offering, expand their internal R&D to external. So there are some places where I think, once again, typically there was no one, and now there are corporations. But in those same areas, that's typically where the government is interested in getting involved, for instance, at the lab stage at the university level to ensure proof of concept, make sure that a prototype can get built. That's the kind of thing that, we fund in New York through a lot of our R&D programs. Then there's typically, a stage during which companies are preparing to raise private capital, but they need formal training. They need to hire a team. They need to substantiate the demand for their product with customers. They need to prove their value proposition. And that's really where a lot of the ecosystem-driven programs the government funds come in, like the accelerators and incubators and other programs that typically, have some sort of little prize package attached to them to help founders bolster their company as they obtain critical information and validation that can be used to raise private funding. And then, we step in again, sort of right where, right between that connective space between having data about what your customer base might be and actually attempting to build something within a system, or to demonstrate something with a customer, or to engage a customer for the first time. You'll see NYSERDA funds pop in very frequently at that stage in a variety of sectors, because without sort of repeat revenue and other sort of substantive track record, a lot of the private investors just are not ready to get involved yet. And then I'll just say, on a totally more mature level, New York's Green Bank has deployed over $1 billion through debt. And that is another thing that, the government can offer, is low interest loans and other debt and financial products that can help scale up technologies after the private, VC community has been involved. So there's sort of, I hope that's helpful. There are a bunch of different areas, but I'll just say really briefly, one, we're really interested right now in things like long duration energy storage, where there's no one solution to provide, 10 to 100 hours of deployable storage. Like we have a pumped hydro company called Quidnet that also has Will and Jada Smith as investors. And we set up a pilot for them in New York, and they are pumping water underground and when electricity is cheap, and they're releasing it when it's expensive. So we're excited about out of the box ideas about that, like that. And then, as I said, some of the more kind of thorny technologies needed to decarbonize buildings. We're all about that. And naturally, as I mentioned, we care about negative emissions. We've seen through studies of New York's emission profile that 15% of our state's emissions cannot be mitigated without on-site capture or direct capture through ambient air of carbon dioxide. So that's a very nascent industry that we're excited to see more in, and we're excited to participate across all the different permutations I mentioned.
One thing I want to caution people, maybe in the audience a little bit, is that we make it sound like it's easy. There's all this money out there. Still building these businesses is really hard. And you, first of all, it's a great time, but you need a lot of persistence in this space, because sometimes the barriers are stacking up just against you, seemingly. If you're an entrepreneur, I mean, the funding side is only one. You have to build a team. You have to kind of build, sometimes educate the market. Someone like Quidnet, for example, Katie, that is like educate them what can be done, and also, but the market is really the important part, and we haven't talked about this much today. It's about winning customers and convincing them that you're to pay for your product. So while you can get to grant funding, government funding, subsidies, whatever it is, and funding like Emily and I deploy, or capital, more the venture side or project financing side, the best capital you can raise is customer, basically sales to customers. So, and I think that's also what will help you grow faster as you move forward. So I think I just wanted to caution everybody, still, while you're looking for all these grants and looking to raise money, don't forget that you will be judged on the customer revenue. And the earlier you can get that into the door, everything else will just make a lot more sense. We will understand the story faster. You'll have fewer hurdles. There's still going to be a lot of them, but also from my own perspective, working as an entrepreneur, it's like never leave your eye off the prize. That's the customer. Try to take as much of the funding left and right from both, especially the non-dilutive parts. But yeah, the customer is key.
I think that's very sound and sage advice. And the financing, it's a means to an end, right? So it's the ultimate goal is to grow, to grow a successful company and to deploy this technology and have the market accept it. So kind of throughout this conversation, we talked a bit about carbon accounting, about carbon taxation, about marketplaces for carbon. I guess I've got sort of a two-part question. One is a pretty discrete and concrete, which is, and it's really, if nothing else, for my own edification, kind of, what are people sort of setting the price on carbon, on a ton of carbon dioxide? What is sort of out there in terms of the taxation or how we're treating that? And then two, I want to use this also maybe as a way to segue into something that's a very important topic and is becoming more prominent, which is environmental social good within venture investing and within the corporate community in general, because I think that some of this accounting and some of this transparency kind of dovetails pretty well with that.
Yeah, well, so the sort of goals around price per carbon, so right now, just to give a sort of primer, there in the US, there is no federal carbon price or carbon market. which would be a compliance market, which would require companies to offset their carbon. There are voluntary markets in some areas, like California, where basically companies can opt into a carbon market, and the sort of goal around carbon prices is to be in the range of basically anywhere from $40 to $80 a ton. But that's probably more like $100 per ton is sort of the goal and the marker. What's happening right now is that there's been sort of ebbs and flows in the voluntary markets through time. There was like a decade ago a lot of demand in the voluntary markets, and that's where we coincidentally had not so coincidentally had a lot of excitement around some of the same technologies we're talking about. There is increasing demand in the voluntary markets again, in part because of what I mentioned, which is that there are companies that represent on the order of trillions of dollars in revenue around the globe who have made net zero or net negative commitments, and they now need to figure out a way to meet those commitments. And how do you meet those commitments? Well, you're looking for high quality and highly verified carbon offsets in order to offset your carbon output. And you're using the voluntary market system to do so. And so that is sort of what has created this interest, this growing opportunity. But the lessons of the past have sort of suggested that it's not that simple and that it's potentially more volatile. And so while things are different, I think there is people who've been investing in this space for a while also have a certain amount of cautiousness about, about not getting sort of too caught up in hype, given lessons of the past. But what we're seeing, just to sort of clarify a bit more too, and Carolyn can share this, is on the startup side, we're seeing a whole host of new startups that are focused just on this carbon sort of accounting piece. So the sort of biggest category I describe is like corporate carbon management, which is that, if you are planning to have net zero commitments or you're anticipating future regulation, you might start tracking all of your carbon output for your entire corporation, right? Down to sort of the travel, down to the scope 1, 2, and 3 emissions, different parts of your business. And then you might actually want a platform that can do all this in this sort of software platform, but also could let you within the platform do carbon offsets, and track your progress over time and report out to some of the standards boards that exist that already require you to report out your progress. And so we're seeing a lot of startups in that space, and it's very early and too soon to tell who might, kind of take the lead there. But we're also seeing startups that are focused more so on the verification of carbon offsets. So one big problem right now in the voluntary markets is that it's really hard to verify that a carbon offset is actually valid and actually of quality, to the point where like you might buy a carbon offset that is oriented around a landowner saying that they won't chop down a tree, but they probably, it turns out they weren't going to ever chop down that tree anyway, right? There's carbon offsets oriented around rainforests, and it's really hard to verify what's actually happening in the rainforests in Brazil. So there's companies actually that have started that are focused on this verification piece of carbon offsets, so that you can create a system that's trusted, that's authentic, that's really genuine offsets, and not just greenwashing. Carolyn, I don't know if you have any other thoughts on that, but that's sort of what we're seeing from a venture standpoint in that overall space.
Yeah, I think it's a perfect summary. I actually don't have anything to add.
I think we saw one question real quick, and maybe Carolyn, you might want to mention this. I noticed someone asked kind of like, how do you evaluate startups from a risk standpoint? And I thought that was a good question. Carolyn, do you want to address that? Kind of
Sure.
The question was like general metrics of risk in our investments.
Yeah, so sure. I think so from our perspective, we don't have like a set standard in our kind of due diligence, it's always the same questions. Starting off with and then it kind of depends, since we invest in seed through Series B, we're looking to kind of course, the risk declining, at least some of them over that period. So so first off, I think we spoke about that earlier today. There's a technology risk. So how proven is your technology? If you can make it easy for investors to show that, either through you already have customers that are using your product, or if you have kind of safety certification, UL, or whatever else is needed. Then there is the team, which is actually, I think, one that we haven't spoken a lot about, just a little bit, but actually the biggest part here. It's very important for us to see that the team is able to execute, and you can show that through multiple different ways. Either you already have that experience and kind of show it in your track record and have references, or you have to prove that out as we go. And I think one thing that we've seen during COVID, doing a lot of the work remotely, is being able to kind of showcase your team and the strength in your team to us as we're doing diligence remotely, is something that some companies really think diligently about how to do that, and others more let it kind of happen or not. And if you're a founder looking for funding, I think kind of that getting to know the team part is one thing that you can have quite a bit of influence on during the diligence process. Then we look at the general business risk. Just kind of, is there any debt? Is there anything that is very capital intensive that will put kind of your business itself at risk? There's the bigger question around the market. So can you show that you are, which I think in the market that we are in, as of 2 years or a year ago, you're kind of on the rising path. In some other markets, or before that, it was much harder. But if you're now showing, hey, we're doing something in the EV space, the general market is growing, how can we benefit from that growth? So that helps kind of de-risking that market risk. I'm sure. And then there is the one thing that I also saw a question about is kind of protection and IP, which is one that is tricky. From my past life at Siemens, I know that a lot of the corporates pay a lot of attention to kind of building out strong IP portfolios. I think it depends on the business that you are building, but it is one thing where we rather put this into kind of in the broader picture of the technology risk and see, is there something unique? And if there is something unique, how is it protected? It does not necessarily mean that you have to spend a lot of money in building out a patent portfolio, which I'm sure people like Jason would love, and his firm would love to help you with, and is very important depending on what type of business you are. But I think to that question, really, it doesn't have to be like, for example, if you're a SaaS software business and you have some machine learning algorithms, it might be beneficial just not to publish what you're doing, but have your trade secrets around your core IP. And yeah, those are the bigger parts, I think.
This has been a fantastic panel. We're not going to end it just yet, but maybe we'll bring a close to the panel discussion, because it seems like we've also kind of naturally. Oh, sorry.
Can I just add one thing?
Sure.
Thanks, Jason. So yeah, no, I just wanted to make a shameless plug. I'm sharing a link in the chat yet again. But this
it keeps just going to the panelists. I can take it and I've been sending them out to the rest of everyone else.
Sorry, guys.
No, that's okay. I've sent the other ones out.
Thanks, Jason. You're the best. So yeah, but we, to the question of like how does NYSERDA at least evaluate companies? You can see all of that in the link that Jason's going to share on my behalf. Thank you again, which is all about a new program we launched called New York Climate Progress, which is a $500,000, $10 million total, $500,000 per convertible note program for climate tech companies. That's actually currently open for application. So next application deadline is April 14th if you want to throw your hat in the ring. But either way, that program and the program opportunity notice attached to it give a good picture of, sort of the state's interest in, once again, the kind of stuff Carolyn touched on around like execution and market risk and technology efficacy, but also climate impact. So thanks again.
Terrific. So at this point, let's transition over to the question section. So if for the audience members, if you've got a question, you may have put it in the chat box and I probably missed it because there's only so much I can monitor. Please put it in the Q&A function and then we'll try and monitor those and get those answered, as many of them as we can. Before we fully transition over, I want to give each of the panelists sort of 45 seconds or so just to provide any closing remarks that they might have or any observations that they've got. Katie, do you want to start?
Sure. Yeah.
Okay.
So I would say, yeah, thanks, Jason. This has been great. So I would just say, first and foremost, like if you're a founder who is excited about technology and maybe you have like a skill set, maybe you are really great with data, or you have a fundamental kind of technology awareness or business kind of orientation towards novel financial solutions, like we need you desperately. And I hope that one thing you took away from the panel is just how many sectors within this whole climate umbrella need your solutions. And so I would just say, right now, more than ever, I think a lot of the programs that focus on clean tech and climate tech are looking for founders that don't have a typical clean tech or climate tech background. So don't be shy about applying to, accelerators, whether they're in NYSERDA's portfolio or elsewhere. It is really important to create a network for yourself in this area within this sector. But I just want to underscore that, we need everyone, we need new ideas. So excited that you're here and hopefully you'll continue on your business formation journey. And then finally, yeah, I would just say, once again, New York is building up a lot of different programs for entrepreneurs in the space. So definitely go to NYSERDA's website, check out the links that Jason shared on my behalf, and certainly reach out to me via LinkedIn if you have questions about how you can contribute your work towards New York's climate impact goals. Thanks.
Terrific. Carolyn?
Yeah. And just to add on to that, if you are not a founder, but if you're looking to make an impact with your time during work or free time, there are a lot of job opportunities in the space. And if you go to our website, bluebearcap.com, and I'm sure Emily and others have the same, we have a careers page there where you can find open job positions on any of the companies that we've invested in. You can also reach out to me on LinkedIn if you're looking to join or interested in joining any of our portfolio companies. I think it's a great timing, both from if you're a job seeker, but also for entrepreneurs hiring people, because it seems like people are paying more attention to how they're spending their time and how they can increase their positive impact on society, not just through energy and climate, but also societal and just other causes that have that kind of, I'll call it old-fashioned double bottom line on what you're doing, not just making money, but also doing something good. So don't shy away from the sector. It's set to grow and set to stay, and we need everybody to be involved who's excited about this.
And then just real quick, I think the themes you heard today were that generally from, these different types of funders and climate tech, like we're optimistic, on one hand, the challenge is great and we don't have a lot of time. On the other hand, there is really movement on the regulatory side. There's more capital there's more technologies and innovation, ready to go, more economical, being deployed. And so it's certainly promising, but we have a lot of work to do.
Terrific. Well, I mean, it's been a pleasure to have each of the panelists here, and it's not over yet. So we've got about 20, 25 minutes or so to start taking some questions. I feel like there are quite a few. So maybe there's a New York specific one, Katie, regarding what's being done for existing buildings in New York. Maybe you can share some insight as to that.
Yeah, sure. So we have a tremendous amount going on. I will just say this, that there is quite a bit happening in the city of New York. In 2019, we passed Local Law 97, which is actually one of the first carbon pricing laws in the country that regulates carbon and energy use of buildings in New York City proper. So that has really spurred a lot of innovation, not only downstate, but also across the state in this category. NYSERDA is working on a few things. I mentioned the Clean Fight, which is a growth stage building accelerator that we launched 2 years ago. That's a program where if you search it online, you can see the types of innovation we're interested in, some of the great business models and technical solutions that we're looking at for Class A buildings. But across A through C buildings in the state, there's a tremendous amount of energy and enthusiasm around finding new retrofit solutions, partnering with manufacturers, and getting all of those innovations out into the market. We have a program called the Empire Buildings Challenge, which is run by our market development group within NYSERDA. And this is a $50 million program total that invites solution providers to propose technologies for demonstration within New York to decarbonize buildings. So once again, as I said earlier, 40% of our emissions, a lot of programs coming down the pike in this area, but those are two that we're running now. And on the innovation team, we're doing a lot around next generation HVAC. We're really interested in software solutions that can help, as Emily and Carolyn said, track carbon emissions of buildings. And if you have any cool building ideas, or if you see a need for another program that you can't find on our website, feel free to reach out on LinkedIn.
Terrific. We've got a question, and we haven't talked about this. We've talked a bit about hydrogen and solar, but there's a question regarding sort of nuclear, and my dog is barking in the background. Sorry about that. Do any of you play sort of in that space, and what do you see kind of coming down the pike in that sector?
Yeah, I'll kick it off. So, I think it's interesting. There's kind of like two sides of the perspective on nuclear. There's some sort of folks in the kind of energy community that are not exactly pro-nuclear. There are others, including myself, that think that nuclear as a source of baseload power, especially with the right safety precautions, is necessary to decarbonize the power sector. And so, the issue is that it's very expensive to build a nuclear reactor. And we have a lot of legacy nuclear around the country that's really old and needs a lot of upgrades. I would say it's not an area that you typically see a lot of venture funding because of sort of the obvious reasons, which it's more of a sort of infrastructure project. It's very long timeframes for construction, development, and seeing your return on your investment. The one area that's picked up more interest, especially from a federal funding standpoint, is an area called small modular reactors, SMRs, which is basically they're smaller forms of nuclear that are sort of easier to construct and set up, and with sort of most modern technology for nuclear. It's also worth noting that some federal government programs and Bill Gates have funded nuclear fusion. And so that is an area, there's a couple companies like TerraPower is one that have attracted a lot of private funding. But I would say my general view on that is it's still pretty, nuclear fusion is the sort of opportunity that's always, several decades out. So it's probably still quite a stretch. But we should dream big. We should have those funders who are willing to sort of put dollars into really ambitious ideas. But I would say overall, you don't find a lot of venture capital going into nuclear. It's still an important part of the decarbonization of the power sector and providing that baseload power.
How about for those in the audience who are interested in just sort of staying up to date on climate tech and developments, are there any websites or resources that are kind of good at a maybe just above consumer level?
I love My Climate Journey. If you guys haven't heard of it, it's a podcast and also community for people getting involved in the climate space that's run by the former CEO of Runkeeper, Jason Jacobs. So that's a really great entry point. There are a lot of stories covered, including that of our VP of Innovation, John Lochner. But there are a lot of stories covered by people in the space that discuss, how they entered into climate or clean tech broadly. So there's a lot of great material there. I'll favorite that one.
Yeah, and on the podcast side or in general, I mean, there's the Energy Gang and the interchange with some of the green tech media folks and Shale Khan at EIP. That's always kind of fun to listen to, and with Jigar Shah now also taking a bigger role in the administration. I'm not sure if he's continuing to be as direct, but I would assume so. I think that also, if you're also interested in tracking what's going on the traditional energy side, which is kind of oil and gas and still affects everything that we do and will for a long period of time. I think the Axios Generate newsletter is pretty interesting. That's one I throw into the ring. It doesn't take you a lot of time, but you will always be on top of kind of what's talked about in the industry.
How about, so we know that with regard to energy and climate tech and clean tech 2.0, New York is very friendly. What are some other good states in the US, or some states that are showing some initiative and drive here that are leading the way?
We actually don't have any other states. I don't know if you heard that, Jason. I don't know, Emily and Carolyn, you want to talk about California?
Katie will never let you back in here. I mean, California is, of course, quite progressive on a lot of fronts, but also very complex. So if you are looking to get into, let's say, the electricity market, California is probably likely not the best place with the complexity of our IOUs here and working with them. I think that we can have probably another hour-and-a-half conversation about Texas, which is a great market as it's much more deregulated as the others, and a little bit of an island as with regards to grid. I think there are a lot of business models that work in Texas, but in not a lot of other states. Outside the US, I would want to emphasize the UK, which has been really innovative in their energy and decarbonization market structures. And I want to also give a little shout out to our friends at Elemental Accelerator in Hawaii, because for some of the more contained solutions, if you think about virtual power plants or solutions that you want to try on a smaller scale, starting on an island is actually not so bad. So Hawaii is an interesting market, I think. There are plenty of others like up and down up the coast here, I think.
I'll just add, obviously, we love all states in New York. One resource that's really good is actually California Energy Commission's website, Empower Innovation. I just shared that, hopefully successfully. So I would say take a look at that if you're in California. I will also share the NYSERDA website, but I just wanted to throw in that Massachusetts has a great network of funded programs. So, Greentown Labs, other, the wind testing facility, the Massachusetts Clean Energy Center. So also really good to look into.
Can we maybe circle back to a topic which we touched on before, which is, why it's important to build product and get customers, and I want to talk about that maybe in the context of when it's appropriate and how to reach out to either VC investors or or to state sponsored or governmental agencies. Can you talk just sort of about a little bit of the nuts and bolts that someone probably could or should do before they reach out to you? So typically I sort of on the VC side, it's, identify firms that are in that space, the partners that are in that space, yada, yada, yada. I don't want to answer the question. I think it's better if it comes straight from the source.
Yeah, so just a few notes on reaching out to venture investors. Most venture investors, are more likely to look at a deal or look at a company if it comes from a sort of trusted source. As you can imagine, just for context, we see probably about 2,500 companies a year, and we only invest in about 4. So your kind of initial step is you're trying to filter through the companies to get some sort of baseline of quality, both from a sort of technology, but also from a team standpoint. And so, really, if you're thinking about raising from venture investors or private investors, angel investors, the best way to do that is to network and try to build relationship with investors. Because even if you're able to have, a promising meeting with an investor and maybe they're not a fit for your round for whatever reason, if they like the conversation enough, if they think the idea is interesting enough, they'll still pass along your company to another investor, and that may be a fit. I have probably introduced 5 companies this year, 5 or 6 that other firms have invested in, even though it wasn't a fit for us. So I want to stress that. I think though, for people who aren't obviously or already, obviously connected into Silicon Valley or wherever there's a lot of private financiers, can be kind of, disempowering to hear that. It's like, well, how do I connect into these venture investors? And the truth is that if you were to do cold outreach, that's also a method you can try, whether it's over LinkedIn or over email. We do look at companies that come in via cold outreach. What I'd say about that though is that it should be really a careful and thoughtful email and careful and thoughtful outreach. What doesn't work is sort of this like grand sales pitch in all caps. It should be a professional, succinct email that hits on key points like growth, revenue, customers, and then attach your deck. And that can work too. And obviously, even if you just get a couple of those responses, but you have good meetings and you start to get more introductions from those initial kind of cold meetings, that can be a really successful tactic to start connecting with investors. And then finally, there's events. Normally in a post-COVID time, there will be events, there will be opportunities to go to places, to conferences, to events where investors hang out. And that's also a great way to connect with people, especially in person, where you have a chance to make more of a real first impression than just an email.
I think that's a perfect summary, Emily. Just one thing to add: for each of those meetings that you have, also ask them, are there other people I should speak to? Can you introduce me to them? So just nurture your network and be really active about that. And I've heard a little bit of conversation about, well, but if this is an investor that decided not to invest, and then they make an introduction, will that be a good introduction? And if you did a good pitch, and if there is a sensible reason that this investor has given you why they're not investing, it's like finding the needle in the haystack. We all have our very pretty narrow kind of scope in our investment thesis. So it's worthwhile to ask that question even from someone who's declined. And we do the same, right? If we declined, or if you declined taking our money, we'd still love you to refer other entrepreneurs to us. So it's a vice versa thing. And I can say in the energy world, we're still a pretty small world, or energy climate, how broad you want to frame it. It's still a small world, so it's a lot about relationships.
Yeah, I think what Emily and Carolyn said was awesome, and like obviously the relationship piece is critical. So I'm glad that Carolyn brought that up. Yeah, I just wanted to offer a few other anecdotes, which are number one, with the government, typically the government hires, if we're not handling direct R&D contracts, many times we hire partners to run programs on our behalf, but our team is actually pretty small. So I do recommend like reaching out to incubators and accelerators and other entrepreneur service organizations if you want to get more embedded with a state, for instance, and then asking the representatives of those programs once you've gotten into them to be an advocate for you. So, many times the heads of incubators or accelerators or other programs, they have a list of potential customers for you or investors. And on the path to unlocking introductions to those individuals, they will tell you, hey, this is what it typically takes to get in front of one of these entities. Like you need to have this ready, or you need to send this kind of document. And that kind of advice can be sort of a cheat sheet on your way to getting in touch with critical parties, to just know yourself, like exactly what you need to bring to the table in order to engage them and get a response. But the last thing I'll say is just, of course, if you hear a resounding no at any point in your journey, it's important to know when no really means absolutely not, don't contact me again. But besides that kind of no, at least I think it says a lot of entrepreneurs, and I know NYSERDA feels this way, and I'm sure other investors do, when you're persistent. So when you take feedback, you go work on the business, you incorporate some of the feedback, and then you come back with another pitch deck. Like, I think that kind of coachability and work ethic means a lot, really, in any of these forums.
Yeah, there's kind of two sorts of no's. Like, there's one no that we'll give that's just like, it's definitely not a fit. There would never be buy-in for this idea, and it's just not a fit with our thesis, or maybe it's too capital intense. There's also another no that's like, not at this time. You're too early. We want to see more revenue. We want to see how this market develops and if it's the right inflection point to make an investment, but we're at least intrigued. And that's the sort of no you're looking for. You can usually get a sense, to be honest, because usually an investor will say, like, I want to stay in touch. But that's where you are more likely to want to do what Katie's describing, which is to stay in touch, to demonstrate progress, to continue to get to know the team for that future fundraising round.
If I can also, I think those were great answers. And if I could also just share briefly some observations that I've seen in my practice with entrepreneurs who've sort of been successful to raise. There's some folks who run it more like a process, right? They identify who's the right person to reach out to, and then the means to reach out to them. One of the nice things these days is that there's a lot of information online, maybe almost too much information, but you can identify generalist funds, which I think Emily mentioned before, right? There are funds that are investing in a number of verticals, down to specialist funds. So you can identify, who might be interested, what field they've been in, what other investments they've made, whether it's PitchBook, Crunchbase, other sorts of things online that you can figure out who, what funds have been doing that, who the partners are at those funds. And then, gain a warm introduction. If you can get that, is a great opportunity, whether that's through an incubator, accelerator, or a professional service provider. That helps alleviate some of the sort of team risk that I think Carolyn was mentioning before. At least gives the investors a sense for a better gauge as to what it is versus like a cold submission. And then, make the connection before you actually need the money, so that you can start to target things correctly. And then, for heaven's sakes, before you make the connection, look to see some funds, and I don't remember if it's yours, Carolyn, or not, but some will say, we are looking for this, we want to see this, we want to see this, we want to see this. make sure you've done your homework and you can, proactively address whatever it is that they're looking for. That'll give you the best shot for trying to build that relationship, make that connection, and get the funding. That's what I've seen. So I think, we're coming towards the end. We've had a lot of questions that, I've tried to have or ask questions that would apply to a broad swath of who the audience was. There were a lot of great sort of more targeted questions. What I'd like to do maybe once again is, have each of the panelists identify who they are, what, where they play in the space, what they're interested in seeing, how to connect with them, and any parting thoughts they may have, whether that's answering a question that we didn't get to, or any other piece of information they want to send with share with the entrepreneurs. You each have, a minute or so. We'll start with Carolyn, if that's okay.
Right. Yeah. So good to be with everyone here. Carolyn Funk with Blue Bear Capital. We invest in digital and data-centric businesses for energy, industry, and climate applications. Again, our typical check size is between 1 and 5 million, and we invest in companies that are post-revenue. So if you're kind of getting towards the first 6-figure revenue coming from product sales, actually, I think one thing going back to like half an hour ago, a lot of entrepreneurs are putting grant funding into their revenues. Please we'll find out like during diligence. So be upfront with where your revenue is coming from. Yeah, focusing on North America and Europe in our investment target. And I think that I want to answer one more question I've seen here in the chat, if I can. There was a question about mining and sustainability in mining, and I think this is a very important topic. We're actively looking in the space because for wind and solar, but especially battery technologies, we need to become more sustainable in not just reusing and recycling, but also in the whole supply chain. So mining is a very important topic. If you have an asset-light business model that's attacking wasteful or non-sustainable mining, feel free to reach out to me. Again, on LinkedIn is easiest. That's Carolyn Funk with a C, and I think there's only one of me. Thanks again to Jason for keeping us on time here, and for Rob for organizing everything, and my fellow panelists. It's been great hanging out with you. Would love to have a drink sometime very soon.
Wonderful. Emily, I'm sorry, I think
you
want to speak.
Well, perfect. Carolyn, we should chat because our newest investment is in that space. So once again, I'm Emily Fritzie. I'm an investor at the Wesley Group. We're a fund in Menlo Park that invests in energy, buildings and prop tech, transportation and mobility, and Industry 4.0. We're usually investing in Series A and B companies, but to be honest, we'll flex down to seed. We'll go up to seed just depending on the company. We're usually investing anywhere from $2 to $8 million initial track with the option for follow-on. And, lastly, what might be interesting is that our investors are financial investors, but also large energy, auto, and industrial companies from around the world, including Audi, Bridgestone, China Light and Power, Duke Energy, Eon, and the list goes on. I don't think I have much else to say, but I'm happy to connect with anyone who reaches out over LinkedIn. If you have a question, feel free to send me a note. And, really grateful for everyone who's passionate about this topic and decided to tune in and learn and hear a little bit more about it today.
Awesome. Great. Yeah, I'll be super quick. So thanks again, Jason, and great to see you, Emily and Carolyn. And yeah, thanks everyone for joining. So Katie McDonald, you can reach me on LinkedIn. I think I'm Catherine on LinkedIn, Catherine McDonald. And please, if you're more interested in everything going on in New York and at NYSERDA, check out our website at nyserda.ny.gov. And if you're a company that's in the market for a $500,000 convertible note, check out New York Climate Progress, also in the chat. Thanks.
Well, wonderful. I think we're able to start on time. We'll end on time today. Today's panel was fabulous. Thank you, Carolyn, Katie, and Emily. It was a pleasure to have you here. Rob, I'm sure you're listening in the background. Thank you for organizing. And Carolyn, also thank you for helping co-organize with Rob on this one. It was a pleasure. I'm Jason Putnam Gordon at Polsinelli. If folks want to reach me, LinkedIn or send me an email, happy to set up an office hour call. Other than that, thank you very much, audience, for your time today. Take care and get back to building your business.
Thanks, everyone.
Bye.